I'd like to address the first question to Prashant, perhaps you. The question has sort of two parts to it. One, how do you sort of characterize the AUM that the firm has raised until now? To give some background on the color of the AUM. And two, how do you see the firm evolve from this point on with respect to new product launches or future growth?
So very quickly, we have, as Vivek mentioned earlier, about $3.3 billion, or close to 24,000 crores. 80% of that is from offshore or foreign investors. About 20% or 4,500 odd is from domestic investors. The reason for greater tilt towards offshore investors has primarily to do with my background, where I have worked internationally for many years, managed developed world money for 8 years, including US and rest of the world, as well as managed global emerging markets for 4 years and managed obviously India for many years. And in doing so, interacted with investors globally, much more so over this time than India investors. With India-based investors, I've only really been interacting over the last 3.5 years in true earnest. Over time, we expect the India assets, as we get better known through these interactions and word of mouth, and first and foremost, due to strong performance of the team, I would expect the AUM mix over time to be more of a balance between offshore and domestic. We already have a good balance between different client types. So little over half of our assets come from global institutions like sovereign wealth funds, pension plans, and so on. 1/3 of our assets come from ultra HNIs like yourselves or family offices like yourselves. And that 1/3 is split quite evenly, half of that coming from India and half of it coming from outside India, from across continents. And then we have about low double digits percentage of assets also coming from endowment funds and fund of funds, and so on. So that way the asset mix is very well diversified by client type and by geographical mix. It is very well diversified across outside India, from Asia, Europe, and the Americas. And from India, it is right now about 20%. But given the performance track record is building up, we expect to scale up in India as well and have more of a balance. In terms of future plans, as many of you might know, we expect to be able to offer mutual funds some point down the line. It is in the news and no secret that we are looking to acquire the AMC from Yes Bank. It is awaiting regulatory approvals. When that is received, we would be offering mutual funds. Mutual fund platform allows us to offer different types, lot more different types of products. And it's too early to start talking about them right now. Ashish Somaya, who joined us a few months ago, who was till then the CEO of Motilal Oswal AMC. Many of you might be knowing him or familiar with him. He joined us, and he'll be in charge of building the asset management company. So I'll pause at that on that one in the interest of time. If someone's more interested, we'll obviously on any of these questions, because I'm going to be brief, or we are going to be brief because of the number of questions, we are happy to elaborate further on a one-on-one discussion if we don't do justice to the answer.
Right, Prashant. So I think the key takeaways, Prashant, are diversity of capital base, both within India and offshore, and even offshore, no particular concentration. Ashish obviously has his hands full with the future launch of mutual fund. I'll go to the next question, Prashant, which is again not surprising, but a key question is our portfolio has performed well until now. From this point on, and obviously the valuations have increased. I think even though we have our own valuation framework, the P multiples that reflect on people's screen are relatively high. So do we envisage sort of keeping names that have performed well, churning the portfolio? So how do you see the portfolio composition going ahead, Prashant?
So look, I mean, I've been managing portfolios for last, if you include the global experience, for last 22 years, India portfolio for last 14 years. And obviously, and many of you, as you know, the performance has been, similarly strong, let me put it that way, over time. And they've not necessarily, the performance hasn't necessarily come from the same set of names every year. There are several names which have been in the portfolio for over a decade, but there are new names that keep coming in the portfolio all the time. The average name turnover historically would be approximately 30%. So when we buy a stock, we feel it's so compelling that we are going to own it forever. And Nitin, if you are able to share, then you can pull up the slide of 10 names, contributors and detractors, where we can see several of the stocks that we have taken action as valuations have increased. So we are very valuation sensitive. It's a very good question. We are not of the school of thought that if you buy something, you hold it forever. Because there's no beauty, no charm in holding a company if there's no value upside, no upside left. The goal for the team is to maximize returns, and not, the team is not wedded to any slogans, if you will, on low churn or buy and hold and stuff like that. So as you see here on this slide here, in the top contributors or detractors, let's take Larsen & Toubro Infotech. Can everyone see the slide, please? Ramesh, Paraya. So Larsen & Toubro Infotech has contributed 11 percentage points to performance. If we had never trimmed it, I wish we had never trimmed it, but if we had never trimmed it, the position size would have been at least 13.5%, because its current position is 2.4%. It's contributed 11% already. So mathematically, its position size would have been 13.4%. But we have trimmed the position along the way, because when we first bought it 3+ years ago, the stock had 90% sort of upside. So we built it a sizable position of 5+% or somewhere there around. As the stock started rallying and doing very well, the upside shrunk. So let's say from 90%, the upside went to 60%. And the position size went up from 5% to 6-7%. While it made sense to have a 5% position at a 90% upside, it does not make sense to have a 7% position at a 60% upside. So for 60% upside, we might have reduced the position, and it doesn't happen in one fine day, but it is a continuum. And as the portfolio is always fully invested, 100% invested. So when we buy something, we need to trim or sell something, and we would trim or sell what is on the margin, become a bigger position for the relative upside in that. So in doing so, Larsen & Toubro Infotech would have been trimmed from 6% or so to 4%, and from 4% then to 3%. And right now also, we do have considerable upside, but it's adequate for a 2.5% position. And that's what the position size, that's the right position size in our view. And that's what we have. The other names that you see in the top 10, like Ipca Laboratories, it more than tripled, in fact, nearly quadrupled from the day we bought. And at peak, it had gone up to nearly 3% position. And at the end of November, we completely exited the name. And it's not that we had 3% and one fine day we went to 0. Along the way, as the upside declined in the name, and we needed capital to buy other names, we trimmed from 3 to 2.5, 2.5 to 2, 2 to 1.5, 1.5 to 1, and finally on November end, when it was included in MSCI, we used that opportunity to exit the name. And the same is true from Muthoot Finance. As Parag mentioned, we bought it first when it was 1.5 times price to book. And on our valuation approach, had very strong upside, one of the strongest upsides in financial sector. And it was one of the largest name in our portfolio. Fast forward 3 years, now it's become a market darling. And the stock has performed very well, ahead of almost every other financial sector stock. And in fact, went to a premium compared to HDFC Bank and other such leaders in the market, at which point there was hardly or no upside left. And so we exited that completely along with Ipca at the end of November. And similarly, other names also that you see here, at some point, L&T Technology was much larger name, and so on and so forth. So that is how, the position sizing is managed by the team to reflect the upside that they see at this time. And new names are coming in the portfolio at all times. And other names are getting added to, because not every name has gone up, right? There are detractors as well as some. It's not that if something is down, we just add de facto. Something is down might be reason to sell them. As you see, many of the names are zeroed out despite being down. But there could be other names which go down but represent compelling opportunity. And so we add to them. And they just haven't appeared on this list as of now on either side. Hope that answers the question, Rishi.
No, absolutely, Prashant. I think it does. And I'll pick up from Prashant.
I want to say it's a great question, and it's a continuum that goes on with the team on an ongoing basis.
Right, Prashant. Thank you for addressing that. Prashant, I'll take a cue from where you left off. If you can keep on that slide, Nitin. If you look at the detractors, can you highlight any one detractor, Prashant, and just mention what went wrong with that name?
Certainly. I mean, look, this is a business where even the best would, have a long list of mistakes. There's no successful investor who has not made mistakes. Same is true with our team. It's like the best of the banks would have still have NPLs, whether it's HDFC Bank or Kotak Bank, they would have NPLs. If you become so risk averse as a bank to not have any NPL, you would not have a successful bank. And similarly, for an investment team, if we become so risk averse that we don't buy a name which has a remotest risk of going down, then we would not have a successful performance over time. So there is a probabilistic investment. The future is probabilistic, and investment decisions have to be made based on where we see those probabilities in our favor. But because it is probabilistic, sometimes it's bound to go against you. To your question, more pertinently, though, a very good question, whether we see any common pattern. Various different names are down or are in detractors for different reasons. But let me still answer the question in saying, let's say, which have been one of the bigger causes over time. So for those of you who are familiar with our investment philosophy, the key attributes which I hope most of you are, so I won't belabor, but the three key attributes for a great business are superior returns on incremental capital, which has to do with its competitive positioning in the industry and the dynamics in the industry of competition. Second is the scalability, the growth prospects for the company. Can it multiply far faster and multiply manifold relative to its current size and faster than the industry peer group and the economy? And third is management, execution, and governance DNA. So if we separate the execution and governance part of the management, I would say several of the names here we have have turned out to be mistakes, let's say, because of overestimating the execution capability of the management in context of competition or otherwise, overestimating the execution capability. Or there could be changes, like in case of Jyoti Labs, there was a change in management, which led to a reassessment for us in terms of our assessment of execution capability of the management. In Bajaj Consumer Care, again, it was a misassessment of execution capability effectively. They lost the risk appetite to expand beyond their hair oil category. And so it was combination of losing the scalability as well as overestimating the risk-taking capability of the management. And then, so in the interest of time, I'll stop there, as that would be, I would say, one of the single. But on the other hand, it is a subjective assessment, and many of the stocks that you see, companies that you see on the right-hand side as contributors, those assessments of management teams have gone very right in each of the 10 names, right? But some of the names like Coforge, it was a change of management, new management taking over. And it was our belief, and Ramesh talked about, the IT sector, it was our belief it was one of the strongest management teams in the industry, despite it being a small cap IT company. And similarly, Naveen Fluorine, these were decisions made on new managements, when Radesh Welling joined Naveen Fluorine. a couple of years ago or so, it was, in our judgment, one of the best things to happen to the company, despite, in addition to the strengths that they have in fluorine chemistry and so on. So there are decisions and assessments of management that go very right, which may at the beginning appear to have some element of risk. And then there's some that go wrong. If we go into a shell and only go for the very tried, tested, proven managements of, and then we'll also, while we might avoid some of the detractors, we'll also end up missing out on some great contributors. In our assessment, the ability that the team has and the track record that the team has, I think has served us very well in that the contributors have been far larger and much greater in number than the detractors. Though obviously it is incumbent upon us to keep on trying to increase our strike rate and learn from the mistakes that we have made in the past.
Right. Hope that addresses the question there. And it's ironically, execution is very, very important, not in every industry and sector and around the world. So thank you for that, Prashant. I'll let you have a moment there, Prashant, and turn it over to Manoj. And Manoj, one of the questions that come for the chemical sector is, you've seen the sector evolve over a period of time. Obviously, there were tailwinds that have assisted the sector over the last sort of 12 months, specifically now with the COVID situation. But how well do you think Indian companies have leveraged this scenario? And what is your take on their investment in R&D, which is obviously going to be very critical for them to be able to sustain the cash flows going forward?
Sure. Thanks, Rishi, for this question. So if you look at in terms of the Indian chemical industries with regard to the investment on the R&D side, I think Indian companies have come a long way. Today, when you look at in terms of fluorination chemistry, but probably we have spoken about Navin Fluorine, or maybe company like, Fine Organics, which is primarily into green chemistry, and again, a part of our portfolio company, they have today invested significantly in terms of building up their capabilities, both from an R&D perspective as well as from the capacity perspective. Today, none of the company in China has the similar kind of capabilities when it comes to fluorinations. Even when we spoke about oleochemicals, which is basically a plant-based, derived kind of chemicals or a green chemicals, because when it comes to chemical, people start thinking about pollution, people start thinking about all the things which you can think about in terms of the bad names which are associated with chemicals. But look at Fine Organics, probably the only company in India which has the oleochemical drives product as the feedstock, and maybe one among the 5 companies in the world which has got those kind of capabilities. So as what I was trying to highlight during when I spoke about the sector also, that we are not looking for a small time kind of opportunistic profit, which might come because of demand and supply mismatch. But if you build capabilities and you work with the innovators, those capabilities are going to stay with you for the next decade, 2 decades out there. And that is where we would like to invest, because those are the cash flow which are sustainable over a longer period of time rather than the opportunistic profit.
Right. So longer term thinking as opposed to shorter term triggers that assist, your company.
And with a very, very strong management track record with regard to the execution. And I think that's what Prashant has summed up very well. When we look at the great businesses, what are those 3 key attributes which we look at? Absolutely,
Manoj. Thank you for that. Ramesh, a similar question to your sector. I mean, I think your sector is seeing, as you sort of highlighted during your presentation, a significant evolution over the last 30 years. And now the question is with sort of new technology, with AI, with cloud being buzzwords around the sector. I mean, do you think more traditional Indian IT companies are sort of, their days have gone? And are there new trends that are emerging? And how are those companies placed vis-a-vis leveraging sort of new age technology?
Sure. So one, all the new technologies that are coming in, whether, triggered by AI, machine learning, automation, analytics-led, there are significant accelerators to technology adoption across industries. Just going back to a few years, a couple of decades back, technology was focused on getting your accounting SAP platform. Today, technology is about acquiring customers, retaining customers through apps. Your customer experiences you your technology first, then they experience the organization, and ability to identify consumer trends through technology. So that way, technology is a significant. These new technologies are significant accelerators to adoption. And today, even for the head of marketing, technology is a key focus area. Unlike earlier, it was limited to a technology head. In terms of capabilities, there was a period when Indian companies lagged behind global companies and startup companies in technology adoption. But now, I would say last 4-5 years, Indian IT services has done a great job of investing in reskilling people into new technologies. I think we probably have the best, largest education program, training program in the world, Indian IT services industry, where they reskill people to new capabilities. And just give example, for example, today for Azure, which is the cloud solution from Microsoft, Infosys is the world's largest global partner. And today, companies like LTI are known for analytics and cybersecurity capabilities. So clearly now that field is changing where, and secondly, whenever businesses want to use a new technology at the start, they use a startup, small venture. But they want to use a technology at scale, they go with the big companies, the likes of TCS, Infosys, the big Indian IT companies, right? And that way, Indian IT services companies are very well positioned. And I want to reiterate again, we often forget that among the top 3 best managed IT services companies in the world, 2 of them are Indian companies, which is TCS and Infosys. Yeah, thank you.
Thank you for that, Ramesh. And just work from home, do you think that's going to well place the industry going forward, or what are your views on that?
Yeah, so I think work from home is a part trend that is here to stay. Whether it's going to be 25% of people or 50% of time, that's of course time will tell. But it's very great for the Indian IT in the sense that Indian IT industry in the last decade has been facing increasingly restrictive challenges of sending people to US through the visa regimes. And work from home has let organizations realize that it doesn't matter much whether you're working from home in New York or in Bangalore. So clearly it has made work from home or offshoring more acceptable. And if US has made people going difficult into US, it only means that since technology unemployment in US is close to zero, basically the developed world only has to outsource technology. And that offshoring will come to India. And remind you, offshoring in India is 3 times more profitable for IT companies than onshoring. So actually, one of the reasons margins have expanded this quarter for IT services companies across the board is simply the share of offshore revenues have gone up, which is the high margin business. So it's a win-win for the IT services over a longer term.
Thanks, Ramesh. Very insightful. Prashant, staying with the same trend of technology, what if our plans to get sort of White Oak up the tech curve and launch an online portal which makes our performance easily accessible to our investors?
So we've got this question a few times in the past, and I must admit, and even we apologize, we've not anticipated the ramp up in the number of client base, if you will, ahead of time, and the requests and different requirements to give top-notch customer service. But this is number one area of focus and attention for Ashish, and he's built a team dedicated for enhancing and vastly improving the customer experience in working with or in interacting with White Oak. I would, on behalf of Ashish, take the liberty to commit that we would, over the coming months, in this aspect, improve to be at the close to the top of the peer group, if not the very top of the peer group. Now, there are certain regulatory requirements and compliance requirements that we have no flexibility with in terms of documentation and whatnot, and we cannot take any chance with those. And you might find that on some of those, we might err more on the side of caution than maybe some others in the industry. But whatever is under our control and what we can fix, we are going to make the best out of that. I'm told that the NAV would be available online by early February, let's say 10th February, and we will be holding people responsible internally to that date. So please bear with us for another 3 weeks. In the meantime, the team is there available to provide that. I know it's not as comfortable and not as modern day with all the technology that Ramesh talked about as it is to check online yourself. But we would be providing that in 3 weeks, and in between, we're happy to provide. Our team would be happy to provide on an individual request basis.
Right. So around the corner, and I'm sure investors appreciate that. Taking a step back and sort of, Prashant, when we were talking about some of the characteristics that define companies when they're either outperforming or underperforming, we kind of spend some time on management capabilities, execution capabilities. How often do we see that underlying performance is driven by operational sort of efficiencies, outperformance, versus kind of multiple re-rating?
See, oftentimes it comes from combination of the two. It's like, to give you an analogy, to just for ease of understanding of a portfolio, let's say a fixed income portfolio, just for ease of analogy. We are not managing fixed income, but for ease of analogy, let's say we're managing multi-credit portfolio and we are investing in AAA, AA, single A, triple B, and so on and so forth. If we find companies that the market is currently valuing as triple B, the bonds that are currently being valued as triple B, but we are convinced that it is a bond that is not going to default, it is a triple A quality bond, and we buy that, then we get the benefit of having a higher yield for the time that we hold, because we are getting it at a lower price than a triple A. And at the same time, sometime in future, the market might realize and come to our point of view that it is indeed a AAA company and not a AAA bond, not a BB bond, right? And so they might raise the price from whatever 80, 85, 88 to 100 to come in line with our view. And oftentimes, it is this combination that drives extraordinary return over time for the portfolio. So many of the top 10, and it is very natural, very normal. In fact, we are looking all the time for companies that are undervalued by the company. And to give the bond analogy, the bonds that might be undervalued because people think those bonds might default in the bond analogy. So like LTI, when we bought it, it was 11 times free cash flow. Forget about PE multiple, which we don't care for and have a deep-rooted disregard for. For our cash flow multiple, as we look at it on OpCo cash flow basis, which is multiple of excess ROIC, it was trading at 11 times free cash flow, when the market itself at the time was trading at about 40 times. And other peers in the industry were trading at high teens or 20 plus times. And this was a company that was one of the fastest growing companies, and sustainably so, with one of the best managements, and was at a deep discounted value. And what has happened over the last 3 years is that not only have delivered that fast growth, faster than the industry, faster than the market has also come to realize that it is indeed a sustainable, great business model and management execution and all of the things that we like to see. And hence the multiple has also gone to reflect, at least to great extent or to some extent, what reality we always believed in. And at the same time it grew, it had one of the fastest growth in the industry as well. So it's a combination of those two that has delivered the 1,000 basis points or so of the performance and the stock multiplying by 5-fold or so.
Thank you, Prashant. Just moving on to another sector, and Parag, you spoke about Muthoot and how there was and is one of our greatest contributors to performance over this period of time. One of the questions that came up with the investor, even though we don't own the stock, your insights will be helpful, was given the softening of gold prices, do we see the future growth outlook for Muthoot to slow down?
See, the gold price, it has no great significance on the stock, right? If you look at a typical borrower who wants to pledge their gold and borrow against it, will probably his requirement is steady. So like, let's say if he wants 25,000, 30,000, or 35,000 to support his consumption, or probably a small business which he or she is running, that demand remains by and large the same, right? It does not change or move with the gold price going up or going down. So that is one. And secondly, if you look at the unorganized market in gold finance, it is, I think in my view, it is 3 to 4x larger than the organized market. So there is enough scope for players like Muthoot to gain market share from the unorganized players. So overall, we believe that the business for a player like Muthoot in terms of gold financing should remain by and large steady, and they should be able to grow 15-16% in all sort of price for gold. Yes, there would be some 1 or 2 year impact, or probably a 6 months impact when you see a sharp correction in the gold price. That's possible. But over a period of time, I think this business can easily deliver 15-17% kind of a growth rate.
Thank you. So you continue to be cautiously optimistic on that name. I'd like to sort of throw a question to the panel, and please, anyone can step up and address this question. Prashant at the outset spoke about 80% of the value being contributed by sort of cash flows 5 years and henceforth, right? And how much a COVID impact and the impact of sort of degrowth this year has a negligible impact on sort of value, inherent value. I think one of the questions that came up was when we were discounting, how fair is it to discount future cash flows at today's sort of low, quote unquote, low yields, wherein one may not know sort of what lies ahead in 3 to 5 years?
Well, I mean, that is the reality, right? You never know what lies 3 to 5 years ahead. I mean, nobody knows, nobody can forecast their personal lives with any degree of accuracy 3 to 5 years ahead. Forget about forecasting, aspects that affect billions of people. So what you do is you take what is the market's best estimate of that on that metric in the future, which is the US long bond rate, 10-year rate, 30-year rate, and so on. And then whatever is the equity risk premium, I'm talking specifically about equity discounting here. So, in the mid 90s, when, I was doing MBA, the long bond rate was 6 to 7%, and we'll take on 5 to 6%, call it 5% of equity risk premium. So the discount rate was 6% plus 5%, which is 11%. Today, the same math would be possibly in dollar terms. Today, the same math would be 1% plus 5%. Even one can argue 5% is too high and should be reduced, because equity risk premium would also be impacted by reduction in risk-free rate. But even if you take 5%, it is 1 plus 5% in the 6% rate. And that's perfectly logical. It would, in fact, be very out of norm and illogical to still continue to use 11% discount rate. You'll miss out on most opportunities. You'll end up sitting in cash, which would generate 1%. For you. So, a lot of investors are worried about, obviously, the PE multiples. I'm not saying not to be worried about, but they've always been very worried about PE multiples. And they keep comparing it to the last 30, 40 years of what the PE multiples of the market has been. But remember, the multiples of the market, the cash flow multiple, which then, impacts the PE multiple as well. These are all relative, and they're relative ultimately to the ultimate benchmark for valuation, which is the US long bond rate globally. 10-year, 30-year long bond rates used to be in the teens in late 70s, early 80s, following the shock, the oil shock. Inflation had gone to double digits in the US. And hence, these long bond rates, and rates are a function of long-term inflation expectations. So because of that oil shock and spike in inflation expectations, interest rates about 4 decades ago were in the double-digit space. And coincidentally, since then, around that time, the technology era basically took off. The advent of personal computer, then mobility, then internet, and technology is very disinflationary. It is because of technology that prices of commodities also are possibly under containment. If you think of what are the key drivers of inflation, I'm going about in digressing in various aspects, but I always get a lot of, and I'm sure Rishi is seeing a lot of questions related to this topic about PE multiples and valuations and all. But technology has been very disinflationary. Two legs of inflation are commodities and wage pressures. Now, in commodities, oil or coal or fossil fuels in general are the biggest driver of commodity inflation. Now, it's because of technology that shale oil, which was there under the ground for millions of years, has finally been able to come out. And it's proven to be one of the largest source of oil, which is outside the OPEC cartel or cartel in general. It is driven by hundreds of capitalist producers, and it's put up more or less a permanent kind of lid on oil prices, right? Also, due to advancements in solar energy and electric vehicles, these were concepts that till a decade or two ago seemed to be limited to laboratories, but now very much are implemented in practice. Because of these advancements, we have a completely alternative mechanism of transportation which completely avoids fossil fuels, coal as well as crude oil. You tap energy from solar, from the sun, charge the batteries, and that would run the cars. Now, that is not happening at a wide scale today, but that's where the future is headed 10 to 20 years ago. Just like in mid-90s when internet was just coming in, we weren't reading newspapers on phones. There were no smartphones at the time, and would have seemed very far-fetched down several generations to expect us to read newspapers on phone. Now, almost everyone on the call here, especially over the last 12 months, would have read newspapers on the phone, and as in general, read newspapers on the phone. So similarly, these solar energy plus battery driven vehicle is going to make, that's what the markets are also telling us, and then seems most logical that it's going to make the combustion engine vehicles face a similar fate as newspapers. And that is going to break the back of commodity inflation, is the market expectation quite possibly. And similarly, with all the things that are going on with artificial intelligence, machine learning, robotics, and so on, and drone delivery, which are again being implemented, all these in US already, and matter of time it spreads around the world. In India even, surveys are being done by drones. So these are all going to keep a lid on wage pressures. And that's why US, despite having a terrific growth over the last 10, 12 years, hasn't seen, and low unemployment hasn't seen inflationary pressures in wage inflationary pressure. So because of technology advancements, which only tech era we are only 4 decades into it. The industrial era lasted for nearly 100 years, 75 to 100 years. We are only 4 decades into tech era. And if this continues, the adoption of technology, and pandemic has only accelerated it. And one of the reasons for the markets to rally could be this faster technology adoption is going to result in, further reduction in inflation expectations from their already subdued levels, which would then merit lower discount rates and hence higher multiples. So I don't see it as an aberration. I see it as a logical thing to do. If you are, as a businessman, evaluating projects, you are going to use a lower interest rate today than what you were using even in India in 80s and 90s. In 80s, 90s, the interest rates were a lot higher, and the discount rate for business projects would have been a lot higher. And today it ought to be a lot lower. Otherwise, you won't be able to conduct business. Your competitors would win and do all the projects rather than yourself if you have too high an interest rate. So I answered a few questions in there, but that is the response to this particular question, Rishi.
Right, Prashant. Thank you. And I know we've gone a little ahead of time. There are a few questions remaining. So, let me start with one of the most common themes coming out, Prashant, and this goes back to where you started.
Rishi, let's do a rapid fire on both sides. You also fire rapidly. I'll also answer rapidly.
Okay, let's keep it at that, and let's keep this concise. Markets. It's our favorite question. Comes back to the lessons we've learned. Good time to deploy. Time to sell. Should I invest now? Is it too hot? What is your deployment strategy? Are you cautious? Are you looking to deploy all in? Just overall markets, Prashant.
So we never take any market timing calls. We are always invested. Cash levels at close to 1% or thereabouts, you must assume. Market timing call we leave to investors or their advisors. We maybe are biased as well as conflicted. Sometimes I see people ask me, what is your honest opinion? As if they expect us to be dishonest and say invest in the market. So yes, we are conflicted and we are biased. For last 35 years at least, 100% or more of my net worth has been invested in equity markets at most times, right? This slide, thanks Nitin for bringing it up. And that is on the back of this experience that this graph that I personally experienced. To us, fixed deposits are a guaranteed real loss. Starting from 85, when I started investing in equities, if you had invested 1 crore in fixed income with SBI, it would have been 8 crores today, post-tax. Inflation itself would have been 12 crores. So fixed income is a guaranteed real loss, not only in India, but everywhere in the world. And that's the reason why in countries where you have low inflation, like in Europe and Japan, you have negative interest rates. Equity market, on the other hand, has delivered in line with nominal GDP growth rate of about 15%. If you add plus the dividend to that, a 1 crore would have been 115 crores. And someone who can add 10 percentage points on top of the market return, 1 crore would have become 2,200 crores. Now, I didn't start with 1 crore, to be clear. I had a paltry 5,000 rupees in my piggy bank. But what I'm saying is, even going forward, this opportunity exists to outperform the market by 10 percentage points or more. The market might not deliver going forward 15% return, but we do think over extended periods of time, as has been the case everywhere in the world, developed and emerging, or most places around the world, over decades, markets deliver in line with nominal GDP, the return. And let's say going forward, nominal GDP growth rate for India is low double digits, 10 to 12%, call it 11. We expect to deliver 20 to 25% return with robust outperformance on top of that. So if I were to be consistent with what I do and I put my money behind my mouth, I would say to be always invested. Yes, if you've had a windfall event of liquidity, you might want to stagger in the market, spread it out over a few months or several months. That would be like buying insurance. It would be negative NPV, but all insurance is negative NPV. And that might be, a good way to take care of the risk.
Thank you. I think that sort of broadly addresses the question around markets, attractiveness, timing, deployment strategy, Prashant. So thank you for taking sort of a fairly broad question. Coming to a few specifics, we've obviously, as you highlighted earlier, seen some churn, name changes, etc. Airtel was one that we saw, in our portfolio. I think an investor would have seen that in our portfolio till about the first half, but now it's no longer there in the portfolio. Speak a few minutes, Prashant, on Airtel, and Ramesh, please feel free to jump in.
So I'll be very quick. In Bharti Airtel, the team was wrong. We went wrong. And if you think about the three attributes where we went wrong in terms of assessing superior returns on incremental capital, scalability, and well managed, it was to do with the superior returns on incremental capital. I think we were too early in jumping to the conclusion that with the consolidation in the industry down to three players, with Jio, Bharti, and Voda itself struggling to survive, that the future returns on incremental capital should improve dramatically and quite substantially. However, we later realized that it is not, at least not happening at the pace that we would have anticipated, and there is much greater uncertainty around it than what we had originally anticipated. Recognizing the mistake, we exited. In fact, exited before the holding did much damage to the portfolio returns, if at all.
Noted. Noted. Ramesh, anything to add onto that?
No, I think, no, nothing to add.
Great. a topic, Prashant, that we're seeing now come up globally is around ESG, and sort of how is our portfolio sort of placed from an ESG perspective. I think, Prashant, if I may, start addressing it, and then you can please elaborate further. And I think one thing I want to highlight is both sustainability of returns and corporate governance form a fairly important element of our investment philosophy. And our investment approach actually naturally integrates the key facets of E, S, and G, all of which are included in our decision-making process. Because fundamentally, we believe that sustainable investment strategy preserves sort of long-term shareholder and sort of stakeholder value. But Prashant, you've been an investor over sort of more than 2 decades now in your professional life. You've seen this buzzword especially come up in the next 5 years. Please, give your views around this topic as well.
So, ESG has gained, increasing importance around the world for investors. The way we invest, our philosophy, even though ESG is not the starting point or the starting objective, what we have seen over the last many years that our portfolios score very highly on any ESG scoring metrics. And primary reason for that is one, on governance. For the team, governance is very much the starting point of the analysis. If governance is not appropriate, we don't even dig deeper into such companies, because even if you have superior business, superior cash flows and scalability and all, it's a great business only for controlling shareholder, not for us minority shareholders if governance is inadequate. Because of the focus on governance, we score very highly on the G of the ESG. Now let's talk about E and S, environment and social. See, again, going back to our mindset or perspective, that value of a business is present value of future cash flows in perpetuity. If a company is indulging in something that is socially unacceptable or environmentally unacceptable, the business would not last in that form for too long. If you see how the world is evolving and developing, the business won't last. It might end up being a finite time frame project, in which case, in our assessment, which is present value of future cash flows, the company would never stand out as attractive as compared to, let's say, what the marketplace might be valuing it at on near-term earnings or something. So hence, for most part, our portfolio ends up having a very strong composite ESG score. And just as a policy, we don't invest in cigarette companies.
Right. And again, I think the key highlight there, Prashant, as you mentioned, perhaps a new buzzword in the global world, but it's always been inherently incorporated into our investment strategy and philosophy. I believe we've addressed most of the investor queries that have come in. If there's anything else, Prashant, you'd like to add on, else I'm happy to sort of close.
I think we've taken up a lot of investors' time, and very thankful for them to have engaged with us, have attended the session, and asked a lot of insightful questions. Hopefully, all were answered. Several were not directly raised because there were other questions that were similar in nature and hence combined by Rishi with those other questions. But if anyone feels that their questions have not been addressed, please feel free to reach out to us separately, and would look forward to engaging with you on a one-on-one basis. With that, on behalf of the team, from the investment team side, we'll say goodbye and turn it over to Vivek or the moderator, as the case may be.
Right. Thank you, Prashant. I think we'd like to thank all of you for taking the time out and attending our first ever sort of thought leadership conclave. This is going to be a quarterly event now, so we look forward to seeing all of you next quarter. And as Prashant highlighted, we're always available. So if there are any questions that have either been unanswered or that come up in the interim before the next quarterly call, please feel free to reach out. You know our best to reach out to us. And we'd like to wish you and your loved ones all the very best, and stay safe and stay healthy.